Good. Well, it's tremendous to have you back. We did an event almost a year ago with S&P, Raphael. So presumably something we did right, because you've been very generous in sponsoring another evening and supporting this and brought some of your colleagues along. Olivia, wonderful to have you along as well. Raphael's very kindly offered to take over my role and be talking to you about what you're doing at Fidelis. So I'll come to you in a minute. But if you don't mind me just talking across you just now for Raphael. So Raphael, you have got a rather interesting title, Head of Insurance for S&P. Can you just talk a little about what that covers and I guess a bit about what S&P is providing to insurance organizations?
Yeah, great. Thanks for that intro, Matthew. And actually great to be back and see a real forest of heads. It looks like a filled up room, so that's great. The insurance market is highly important for us. We've been covering that for many years. S&P is an organization, 160 years old, helping the market understand, what are some of the risks from perhaps an underwriting perspective. But more specifically within the insurance space, my role is really focused around, how do we identify future growth opportunities within the insurance market, also validating some of the customer demands, as well as steering some of the cross collaboration across the 7 different divisions which we've got. So across mobility, commodity insights, Platts, obviously you've got the ratings business, sustainable one, and the indices piece as well.
Tremendous. And since we got together last year and talked about this topic, what have been an example of some of the sort of major developments you've seen just across this whole area of ESG and climate reporting?
Yeah, so it's been a growing area and continued focus. I think the best way to perhaps describe this is, when we look at the world, there's 3 main key points in which we're focusing in on, and most of the conversations that we're having with our clients are centered around these 3 key points. So the first C is around conflict. A lot of conversations we're having around supply chain issues, what's happening with the macroeconomic environment, what's happening with inflation, and some of the possible solutions that we're helping our clients address some of these challenges with is around, the global economic country risks, supply chain analysis, and in the maritime space. The second C is around the climate piece, which, to your point, is key, and that's also what we're here to start to talk about. So climate continues to be a key area, particularly from a physical risk perspective, as well as some of the transition risks, in which many of the folks that you speak with across the market are trying to identify and also solve some of these challenges. And we'll get onto it when we speak with Olivia. And to this, we're focusing in on, bringing you in new data insights from ESG scores to climate credit analytics to, portfolio analytics, exclusions, many of the themes that we're seeing within the market. And then the final piece is certainly around how do you maintain the competitive advantage? So, working with data providers across the market, ingesting data through different delivery methods, such as feeds, cloud, APIs. And we're doing this not just from a climate perspective, but also other major risks we're seeing across the globe.
Great. Yeah, I mean, certainly some of the things you mentioned in there, we wouldn't have anticipated this time last year and have been sort of the background of challenges. And also, Raphael, you did really well. You only mentioned one acronym there, ESG, but just warning is the wrong words, because I'm sure our panelists are going to help on this. But insurance, we have 3-letter acronyms. In the world of climate and in ESG, they seem to prefer 4-letter acronyms. So our challenge for you tonight as the audience is to make sure that if any 4-letter acronyms come up, the rule is, if you're a panelist and you use our 4-letter acronym, we're going to expect you to know what it means. So to see if we can get through that for this evening. But Olivia, Raphael, I'm going to pass over to you now to continue the discussion, find out a bit more about what you're doing at Fidelis.
Yeah. You got a mic. So Matthew, one of the things you talked about earlier was, what's changed over the last year. And, one of the major challenges or the major opportunity and growth we've seen is with acquisition of IHS Markit, now an organization of over 35,000 people, helping serve global markets to, power the future of the markets. It's been an exciting journey for us. Olivia, maybe I want to flick it on to you here, having joined Fidelis earlier on this year, obviously looking at ESG and underwriting. What are some of the strategies you've been putting in place, or should the market be thinking about when, trying to address these topics?
Sure. I mean, it's a huge area, but I think just picking up on the physical climate risk point, I think that actually is one of the easier aspects of dealing with these topics. So if you think about what the insurance and reinsurance industry does, is we have a big role in managing the impacts of natural disasters, natural catastrophes, and that's obviously key to the whole discussion around physical risk. So in a way, sort of managing the strategy around that shouldn't involve anything groundbreaking. It's really factoring in climate change into how you're already doing your business. So, starting from the modeling of natural catastrophes across different perils, different regions of the world, aggregation modeling, capital modeling, scenario stress testing, all these things which the industry already does and does very well. That needs to be adjusted and made significantly more dynamic to reflect the realities of climate change. But in a way, that's the easy bit. We obviously need a lot of sort of data and insights and analysis to feed into it. But I would say some of the more challenging bits are actually around the transition risk components. So in particular, on the sort of negative side of avoiding some risks, how do you reposition your business to, take into account the fact that some of these industries that we've been serving for a long time have fundamental strategic challenges and will need to shift. There will be some stranded assets. How do you sort of factor that in? But then on the more positive side, how do you make sure that you can capture the growth opportunities that are related to transition? And I think those kinds of discussions fit less easily into existing frameworks. So on the physical risk side, I think it's more around data and making sure that you are factoring in, for example, loadings for climate change into every relevant risk, which is something that we do at Fidelis. It's obviously never going to be the exact right answer, as with all insurance modeling, but directionally, that's the thing that you really have to focus on, I think.
Yeah, and you make a good point, particularly around the transition risk there. My question, I guess, sort of kind of pivoting away from that, is around the portfolio alignment. There's many challenges that we see in terms of, structuring the portfolio in the right manner and in line with the organizational structure and appeasing stakeholder requirements. But how are you going about that in managing that as you go through the transition?
Yeah, and that is much more relevant to the transition component. I mean, on the physical side, obviously, when you review, all the different factors and how climate change is having an impact, you may change your risk appetite for certain perils, certain regions, but that's more of a refinement. I think the real structural changes in the portfolio mix are to do with transition. And there are a couple of different aspects to that. Obviously, one is how you deal with some existing heavy emitting industries, but there's also a much more exciting element, which is around product innovation and what can the industry do to support that. So there, we have some products which are already very well placed for that, and obviously renewable energy is probably the most obvious one. But there are also new technologies which are emerging where we can play an instrumental role, whether that's around hydrogen energy, hydrogen as it applies to different industrial applications, carbon capture, also the carbon markets. These are areas which on the face of it may seem like they're quite new and quite daunting for underwriters, but actually if you dig into that, and I think that's something we need to do more as an industry, you start to break down the risks and you understand that actually various aspects of that are already being covered. So, on the carbon market side, a lot of those, non-delivery, non-payment, political risks, fraud, negligence, these are all things which we have a lot of experience as an industry in covering. So you need to adapt that and take it forward into the reality of a transitioning economy. Similarly with some of the, hydrogen projects, for example, construction risk elements of that are quite familiar to underwriters already. So I think there it's really about breaking up the risk into something we can understand and innovating products to better meet the needs of that transitioning economy.
Yeah, and just as we, I guess, transition, there's a lot of talk around moving to or net zero by 2050. One of the major challenges, or at least discussions, I was in the US last week, and a lot of the conversations was dominated around the regulatory piece and disclosure. What are you doing to sort of get ahead of the curve in some of these disclosures that are coming up and regulatory pieces that we should all consider?
Yeah, I mean, it's obviously depends on what jurisdiction you're talking about. It should be some kind of minimum at least. So we absolutely do look to be ahead of that. Particularly on the disclosure front, where for us specifically there isn't a huge disclosure requirement. We're also not a listed company, but we feel that actually disclosure is incredibly important in a number of ways. It holds you to account. It makes the commitments that you internally decide real. You have to be prepared to really act on those. And it also triggers discussions and thinking really concretely about what it is that you're doing. If you have to put things into a public report, you have to go to the regulator. Those are things that really lead to questioning internally as well and can trigger real change. So I think it is very, very important. For us, we have signed up to ClimateWise, which is a voluntary framework, definitely not required by our regulators. But we feel that also as part of that group, being involved in those discussions, it's more than just the disclosure. Mm-hmm. It's really sort of shaping the topics and seeing how that then influences what you really do in your business.
Fantastic. Well, that's the alarm there. I think Matthew's giving me the eye on the corner here. What's going on, Raf?
Not at all. It's tremendous. I'm just very glad we're recording this because there's so much great content in there. I'm guessing, Raf, you've kind of finished your questions then for Olivia for now.
Yeah, they're the questions I had.
No, it's tremendous. Olivia, thank you very much. Raf, thank you for joining us on stage.
Cheers. Thanks a lot.
Thank you.
Tremendous. Well, there's a lot of things to pick up on there, and you'll glad to know that our panelists have conferred. So we're building on what's already been said, I think, rather than repeating it. But Chris, I'm going to start off with you. You're global head of M&A at S&P. And strategy. And Ralph sort of give us a little bit of what's happening on the insurance space, but can you just, it'd be good to hear how you think about these topics. You talk about E, S, and G. I think often we kind of think more about maybe the E side of this, but how do you characterize climate and E, S, and G when you look at it at S&P?
Well, thank you. And I'm just looking at the clock. We don't have 3 days for me to describe my thoughts on ESG, so I'll try to keep it brief. Look, from my perspective in my role as the head of M&A and strategy for our sustainability, for Sustainable One, which is our sustainability center of excellence within S&P Global, my job is to think through what are the broader macro trends and things that we need to be exposed to as an organization, and what are the challenges our clients are facing today. So when you think through things like ESG, for example, you're right, we do spend a lot of time thinking about climate, and obviously that is a pressing thing that we need to work through. But more and more what we're seeing is actually an integration of many different factors and a thought process that you can't just look at one item without the other. The idea that there are a variety of important metrics and themes that people want to involve in their decision-making process, and that completely disaggregating it might miss certain points. So what we're seeing are a lot of people that have different views and leanings and things that they think are more important, but also a view that there needs to be some degree of combination of those different metrics and thought processes, and there can't just be one size fits all answer.
No, I love that. And you mentioned at the beginning about giving your kind of point of view on this. Is that something that people outside of your clients can get access to, or do you sort of preserve that for your clients?
Well, again, this is one of those things where if you were at home, I think my girlfriend would tell you I clearly tell my point of view to people. But the challenge is, I think, I have a lot of conversations with clients, with partners, with a number of ours. We have a pretty active venture portfolio as well, where we work with our venture portfolio companies to help them think through their business models. And in those conversations, we kind of go through the whole spectrum of things. And my job is to have that conversation ongoing and continue to add value for those folks that ask for it. But in this capacity, if anyone wants to speak to me afterwards, more than happy to have a conversation on any of these questions you might have.
Great. And then Olivia was talking about physical risk. I know that's one of the areas you're looking at in particular, some of the challenges of as you look forward into the climate, what's happening. Can you talk a little bit about what you're doing in the areas of physical risk? And I'd also be particularly interested, sort of back to your point about all the information out there. What's the balance between, I wouldn't say easy, it's never easy, but what you can have more certainty around how you're analyzing versus where you've got greater uncertainty when you look at some of the impacts on physical risk?
Got it. So we'll take a step back. In physical risk, I think the earlier panel did a great job of kind of walking through the importance of physical risk, so I won't rehash it too much. But if we think through what are the impacts that we expect to have from the changing climate and from various potential scenarios, physical risk is a major concern, particularly for those who own large-scale assets or anything that might be impacted. So we saw things, for example, in California wildfires. You have growing wildfires and additional things within Europe. So from a physical risk perspective, what we're trying to do is work with our clients to help them understand what their degree of exposure is, in particular on major assets and across the broader portfolio. I think in terms of level of comfort, we recently purchased an asset called the Climate Service. So we brought in a new business where they had cutting edge technology within measuring and quantifying physical risk. We're very excited about that asset. We've actually been scaling that up and combining that with the various data sources at S&P, along with our broader reach, to try and take that business to the next level. I think in terms of degrees of certainty, look, where we are today in terms of opportunities and where we think through in terms of data is there is still a degree of modeling and there is a degree of input, but at the same time, I think where we're potentially seeing the most opportunity or where there's more opportunity to refine is probably on the transition risk side. I think there's a lot more work to be done in terms of quantifying impact and opportunity for the transition.
I'm hearing a theme here with transition risk. So I think everybody in the room will understand that, but just for those that don't, that relates to the opportunity to ensure new assets or emerging assets that are being used as we move away from carbon emitting type assets. And obviously that's got challenges with it, but it's also got opportunities. So maybe we'll talk a bit more about that, Rachel. And I mean, good, glad that's consistent with what we're hearing so far. And then one more question for you, Chris, and then I'm going to come to you, Rachel, and we'll come back to Chris. But Scope 3 emissions, we hear a lot about the challenges. So for those that don't know what Scope 3 emissions are, those are the emissions that are coming in from your clients in very simple terms, which of course, if you're an insurer, is quite difficult because you don't have full visibility into that, and there's a risk of double counting and all sorts of other complexities on it. So one of the big challenges for the industry is, as people are being asked to report on their carbon emissions, is how do you actually look at Scope 3? Can you talk a little bit about how, in terms of how you're seeing organizations tackle that, your clients, yourselves? What are some of the things people are doing to try to be able to get some credible understanding of Scope 3?
Well, it is a major challenge. We're having a number of conversations with clients who are trying to sort through that piece. I think what we're seeing is an evolution in terms of the ability to capture that type of data and model out certain places or fill in certain areas where you need to fill in those gaps. It is still a work in progress, and there are a lot of areas where there are solutions and data, but we'll continue to refine those solutions as we move forward in terms of solving the Scope 3 challenge. I think where we are now is working on a best efforts basis. We have obviously solutions, and a variety of others do as well, but I think we're going to continue to evolve that answer to that question, and that's going to require a bit of continued evolution within the data provider and also within the company provider space.
Good. Well, I'm sure Anna and Rachel will have an answer on that one as well. So, Rachel, just for you, Head of Sustainability at Convex, can you talk about frame this in a way that, because we're all metric driven these days, in 12 months' time, how have you defined that you've been successful in your role at Convex?
That's a good question. The Convex is a relatively new company. It's only 3 years old, so I'm trying to put in place an ESG strategy across a new company. And that is in itself is multifaceted, so it's quite a challenge. I think, in short, how would I be successful? That I will have some way of evaluating the ESG, particularly the climate, the emissions profile, and the ESG profile of our investment portfolio and our insurance portfolio to today's subject, and that we have defined how we're taking advantage from an opportunity perspective, as well as the responsible approach that we have towards the business that we're insuring and that we're investing in. So there's a lot to pack in each of what I've said there.
Yeah, no, it's very measurable. And I'm really pleased. I want to come back to this transition risk one, because sometimes we talk about this area of ESG, we get too obsessed by the regulatory side. And it's just really good to know that we're talking about the opportunity from this transition risk side. Right, we've got our first acronym coming up. I'm actually going to throw this out to the audience. You're going to have to shout it out. Stick your hand up. Does anybody want to take a crack at PCAF? Rachel, anyone going? Okay, I'm not going to put anyone in the spot. PCAF. Rachel, I'm going to ask you to explain what's happening with the consultation.
Well, what it stands for.
And what it stands for. I can tell you what it stands for.
It stands for the Partnership for Carbon Accounting Financials. So what PCAF is, in my view, is a very good thing, because as Matthew referred to, we have to, as insurers, we have to look to our Scope 3. So we relatively newly will have to look to, just because it hasn't been done thus far, the emissions associated with the assets that we invest in, and also what we insure. So this organisation PCAF, which oddly enough was started by 14 Dutch bankers a few years ago, it's a voluntary organisation, and they created a methodology that investors can use to assess the carbon emissions associated with their investments. And that's relatively straightforward for investments, because in essence, if you have 1% of the equities of Unilever, you take 1% of their emissions portfolio, of their emissions. On an insurance side, it's an awful lot more complicated because you could be writing the first layer of their property, you could be writing their casualty on any one insurance. So it's more. So they have this year developed this methodology associated with it's called Insurance Associated Emissions methodology, and they've gone out to consult on that. They've worked closely with another acronym with the Net Zero Insurance Alliance, the NZIA, and that's made up of some of the big companies like AXA and Swiss Re and Liberty, etc. And they put it out to consult with a broader, the market in general, anyone could comment on it. And it's been well thought through. And what's good, in my view, is that we want one methodology. We don't want everyone having to reinvent the wheel on this. So it won't be perfect, but it is essentially, and how it works is that you will add up the premium you get on the different different insurances that you underwrite, and you divide that by the revenues of the Unilever of the firm, and then you take that as a proportion of the emissions. So there is a fairly well thought through methodology for this carbon accounting of underwriting, and it will no doubt not be perfect, but it is at least somewhere for us all to start on.
Just make sure I got that. So you take the premium and divide it by the revenue
of the firm, yeah, of the entity, yeah, and then you take that and then you take the emissions. So
Good.
Yeah.
Okay, I'm glad we're recording this. And this was under consultation. Just remind me where.
No, well, so it's been under consultation
Right.
this year. They've now come out with their framework this month. There was an awful lot of ESG-related frameworks and standards coming out this month, and I think that's one of the reasons why when people say, is COP a good thing, is COP27 a good thing, I think a line in the sand is quite useful because it means that, yeah.
And that's presumably all on. I hope it's online. Crikey.
Yeah, there's pages on this, and
sorry.
yeah.
Good.
So I think in essence, why do I think it's good? Because I think it just improves the transparency. So, instinctively think, well, hard to abate sectors like in aviation and energy are going to have greater emissions, yes, but having this data will allow us to compare sectors, geographies, and allow us to pour a certain lens and ask further questions where we then want to develop more information.
And you mentioned NZIA, Net Zero Insurance Alliance. How's that getting on, really? Going well?
So, yes, I understand it. It seems to be going pretty well. They've got a number of members. We are likely to sign up. We haven't signed up yet just because you have to, they sounded quite very serious about having science-based targets that you announced within 6 months of signing up. Actually, the target setting that they've just also come out with their target setting protocol for consultation now, which is essentially they want you to have targets associated with your carbon reduction. They want you to have targets associated with the coverage, with how much of your business that you're getting. Because of course we're sort of talking about data here, but this information is not. It's very relatively easy to get for all its imperfections on big listed companies for whom the S&Ps and rating agencies and others have this information, but it is much more difficult to get on private companies. And I don't know if we're coming on to that, but that's somewhere where it would be, if the more consistency we can get as a market, and for example, the brokers could play quite a useful role here in just getting the certain key basic data points that we want to be able to get from a lot of companies. And then, I think it's up to us insurers to then determine what more data points, how do you want to look in a more nuanced way yourselves, asking more sort of penetrating questions on what they're doing towards transition.
No, we certainly are coming on to it. It's your next question. And you've answered part of it. And then Anna's going to talk us a bit about what's happening with Sri. Yes, so read it out, just to prove it's in here. Collating and reporting will require considerable quantities of new data. What's been your experience of ESG data? You've given us a bit. Are there any, just for somebody that actually wants to go out and find some concrete examples in addition to what S&P are providing, anything you can recommend or any tools or data sources for people to go and look at to help them at least start the move towards being able to measure this?
Well, I mean, if you look on S&P, for example, there's lots of very good ESG-related data points. I think getting that emissions profile is very good. I think there was one, for example, there's a data point on a company's Paris alignment. So to what extent is the company's ESG strategy, the net zero strategy and their commitments. How is that aligned to a 1.5 degree target that the world is looking for, or are they more on the 4 or 5 degree? So that's a great, I think that's and as we go on, the rating agencies are getting better and better. That information is not only are they covering a wider, I'm selling your services here, and not only are they covering a wider, a broader platform of companies or firms, but also the sort of refinements beneath that are getting improved. So I think there's, I think there's I think there's lots of good data points, and it's up to you. And there's certain basic ones that you'll need to determine your net zero strategy. But then you can then start to ask more, to look for within that more penetrating questions and more penetrating points as to what it means towards. So, for example, do they have asset specific? Do they have subsidiary level? Do they have? Can you tell, what geographies or sectors they're serving? So, if somebody, for example, is if a lot of the market is in a developing world as opposed to OECD, that might make your transition expectations for that firm different. So the better intelligence you can get in that way should better inform your strategy and the sort of intelligence of that strategy, so that you're not just meeting. I mean, to my mind, we're not all just trying to meet metrics that allow us to be able to make statements that say we've, where we are, or what sort of S&P rating we're meeting. It means that we're actually responsibly engaged with supporting a sector and a firm towards transition, and they're all going towards transition. I mean, the magnitude of finances that's going on transition is supposed to be 4% of GDP annually to 2050. I mean, it's just enormous sums. So all these sectors, so many sectors will be changing radically and are changing, that we really need to get on top of it.
No, there's a lot in there, and I think, Rachel, we should need a longer discussion on this one separately, because I know there's a lot more you can add to that. Or just one point you made in there, I think, is when you talked to me about it before, it was very obvious, you mentioned it, but I hadn't really thought about it. It's a difference, you mentioned assets, so the difference between knowing a company and what their emissions are and is one thing, but actually what your point is like down to the ideally individual property or campus or location, as opposed to just like one single number. Anna, I want to turn to you now. Sorry. So you've had experience working for Travelers Insurance. You've worked for Lloyd's. You're now at Swiss Re. What's Swiss Re doing these days around ESG? It's a long question as well, so feel free to narrow it down to something
also
specific.
This is like 3 minutes, 51 seconds. No, I mean, look, we had a really long sustainability journey starting in 1979. I think the areas of focus are very similar across the industry. I mean, you have operation, asset management, and underwriting. Operation and asset management are slightly more developed, and the focus is really on underwriting. We had some significant milestones. Maybe in 2009, you remember we developed the Sustainable Business Risks Framework, which we still use, and it's called ESG Risk Framework. In 2018, we decided not to insure thermal, so really big milestones out there. But underwriting is really the focus right now, because we want to embed sustainability at deal and portfolio level. And at portfolio level, if you want to embed sustainability, you need to assess portfolio, you need to understand your ESG risks, and you need to be able to come up with products that ensure companies addressing sustainability challenges. And the bottom line about all of this is that sustainable business in the longer run is good business. And the way we want to, when you want to embed sustainability in underwriting, the way we do it is two ways, right? One, which is typically what everyone goes with first, is exclusions. So you have sectoral policies, country exclusion, companies exclusion, referral tool. And the one we have to move in and we're moving into is inclusion. So you use carbon steering, you try to understand the impact of your portfolio in relation to the sustainable development goals. And you really try to come up with new products. And that's the area where we all need to go into, is looking at exclusion and inclusions.
So just to be clear on that inclusion, so is that on, you mentioned, I think at the end there, is like looking at new types of risks. That's the transition one. So you're actually balancing of course you have to if you're going to maintain your revenue. You're balancing your exclusions with the new areas of risk. Okay. Correct. And then you're also offering data as I guess it's a product in its own right to other underwriters. Is that right? To be able to measure their own emissions?
Yeah, correct. So as you probably know, I mean, we've been offering solutions to the market for a long time, but we have a very exciting news. You know, we are going public with our external solution company the 1st of January 2023. And that is, you know, look out for solution 1, 2, 3. And as part of our solution suites, we have 6 verticals, which are property, specialty, auto, mobility, digital risks placement, and P&C analytics, and I forgot one, which is claims assessment. P&C analytics has a very good sustainability analytics suite. And you have physical risks, which we discussed, ESG and sustainable development goals, and transition risks. And this is where the carbon intensity model that we developed internally, originally based on the CRO Forum carbon footprinting methodology that was done in 2020 and now been updated following the PCAF methodology that was released last week, is based on. And this model is there for our use because we have really ambitious target to become net greenhouse gases emission by 2050 across all areas, including underwriting, but also because it is business relevant, and we also have a lot of scrutiny from investors and regulators. But fundamentally also it is there to help our clients, so insurers who are on the same sustainability journey, to understand the carbon intensity of their commercial and auto portfolios, as well as understanding the impact of transition risks on their insurance demand, because that will significantly impact the insureds in their portfolio and how they buy insurance.
Anna, you're going to need to hold an event in January to release your new model, because everyone's now really keen to learn more about it. One final one, you're offering, or intrigued by this one, deep dive carbon intensity model. Can you just talk about what that is?
Yeah, so that's what I just mentioned, you know, based on CRO Forum being updated on the PCAF standards. And what you really get out if you work with us and use our model is 3 outputs. The first one is you understand the intensity of your portfolios. The second is you get a benchmark of your portfolio compared to something similar that is out there. And the third one is really understanding the impact of the transition risks of your insureds. What you do with it normally is either you have conversation with brokers and insureds, you try to start thinking about business development and where to go next, because your insureds will be perfected. You potentially start looking at your ESG strategy, your targets, and you start measuring, which is really important. So these are the 3 areas we see clients using the model we've developed. And please do reach out in the break, if you want to know more.
Thank you, Anna. Well, Anna, Chris, Rachel, we've run out of time now, but I certainly, speaking personally, you've definitely whetted my appetite to learn a lot more on this topic. So looking forward to talking to you all more about it and sharing that more broadly. But thank you again very much for covering a lot in a short space of time and informing us a lot of what's happening and going to be happening going forward. Thank you.
Thank you.
My name is Rebecca Boston. I'm the Director of Research and Insight here at Instech, and I'm joined by my colleague, Ali Smedley, who's the Senior Research Associate at Instech. And we're really pleased to be joined by Christy Asili, who's responsible for sustainability and ESG solutions within the maritime trade and supply chain at S&P Global Market Intelligence. As part of her role, she interacts daily with different players in the maritime trade and supply chain industry to understand their sustainability strategy, emissions reporting obligations, and decarbonisation ambitions. It's really interesting for me and Christy to be on stage together, because less than 2 years ago, I would have actually called Christy my colleague. Prior to joining Instech, I actually worked at IHS Markit, which is now S&P. I unfortunately did not work in the more cleaner end of the energy field. I worked in oil and gas. And talking about more carbon-intensive industries, I thought it'd be great for the audience to understand why we're talking about the maritime sector. So I looked up some statistics from IRENA, which is the International Renewable Energy Agency. International shipping enables 80 to 90% of global trade. It represents 70% of all global shipping emissions. And then the third statistic blew my mind so much that I actually had to confirm it with Christy. So if it was a country, it would be the equivalent of emissions of Germany. So 3% of global emissions. And that's why we're talking about it today. And the reason is because 80 to 90% of the fuel used is still fossil fuels. And that's unlikely to change in the immediate future, though things like we talked about, hydrogen, they are definitely options for the future, but they're not immediate solutions for that. We talked in earlier panels about scope 1 to 3 emissions, and in relation to maritime sector, it's about insurers investing in maritime assets, but also the underwriting and the claims handling. So Christy, as with most carbon-intensive industries, a lot of pressure to decarbonize, to understand their carbon. But as actually with quite a lot of different industries, there's a lot of disparate emission reduction targets, calculations, and disclosures. Can you explain a little bit about what's going on there?
Yes, that's part of my headache every day at work, so happy to share the headache with you today. First, let's start with targets. So when we look at targets in the emission industry, the regulator that we look at is the International Maritime Organization, which is the regulator for the UN body that regulates shipping. So the IMO has set an initial GHG strategy, which is of reducing the emissions of the industry by 2050 by 50% compared to 2008. And the problem with that target is that in terms of absolute carbon, the amount represents twice the amount that is in line with the Paris Agreement. So the target set by the IMO, which is supposed to be the body that we look at in shipping, is completely misaligned with the Paris Agreement. So what happened is that you have coalitions that are led by the private sector that have set an alternative target, which is the target of reducing the emissions of the maritime sector to net zero by 2050. And then you have a third set of targets which are in line with the Paris Agreement, which aimed at reducing the shipping's emission by net zero by 2040. So it's really soon. And this is in line with the science-based targets. So 3 different set of targets. And then when you look at calculations, there are 2 ways of calculating emissions in the shipping industry. One is with what we call primary data, which is the real operational data that is coming directly from the fuel consumption of ships, which is the preferred way of calculating, obviously, because it's the real data, but it's very sensitive, and ship owners are sometimes reluctant of sharing that. I say sometimes to be politically correct. And then the second way is using heuristics, so what we call default data, which is a set of factors that are off the shelf that tell you on average what a ship would consume. So when you tie together targets and calculations, this is when you can move towards disclosure. So bringing together strong targets and a sound way of methodology for emission calculation is how you can get to a portfolio level disclosure. And the problem with the shipping industry is with so many different players and so many competing interests, the value chain is extremely segregated and fragmented when it comes to both calculation and targets.
So as with many industries facing similar issues like that, we also heard earlier on, I think Rachel was talking about the NZIA, insurers coming together to improve understanding and measurement. But actually, the insurance sector and the maritime sector have been coming together to create some data collection standardization. So can you just tell us a little bit more about the Poseidon principles for maritime insurance?
Yes. So I'm not really familiar. I wasn't familiarized with the insurance space before working with the signatories of the insurance space. But it's true that sometimes the insurance space is shamed as being, old-fashioned and lagging behind. But actually, with this initiative, they've proven to be very effective and a trendsetter. So what is this initiative about? It's a group of hull and machinery insurer that have come together to commit to disclosing the carbon footprint of the hull and machinery portfolio that they are underwriting. And the way it works is that if you are insuring a ship, you call the ship owner and you tell them, hey, I'm insuring your ship. I've signed up to the Poseidon Principles for Marine Insurance, and I need the fuel consumption report at the annual level of that ship for the last year. And then they do that for the whole portfolio of hull and machinery, and they aggregate the data into a whole portfolio assessment. And then that portfolio assessment is put against the trajectories, so the 3 different trajectories, which is a headache for the insurers, and calculate how far off their portfolio is to that target. At the moment, it's a voluntary framework, so ship owners can inform the insurers that they don't want to opt into the program. However, there is discussion of including the data sharing requirement in the underwriting clause moving forward. And we've seen with the charterers and with the banks, the ship finance banks, that including a clause in the charter party agreement for the cargo and in the debt refinancing, for the ship finance bank have proven as an effective way of pushing ship owners to be bound to share this data. So hopefully the insurers fall in that category too.
So in terms of actually reducing emissions, it's difficult to do that until you can measure them, and you can't measure them unless you have a good handle on your data. How are you helping signatories of the Poseidon Initiative with this?
Yeah, so little sponsor moment from SNP here. We have developed a software solution which is a data managed platform that completely automates the data collection aspect on behalf of insurers that have signed up to the Poseidon Principle Initiative, whereby we reach out to ship owners on behalf of an insurer and collect the fuel consumption data that is needed at the annual level to perform the portfolio calculation. And the problem with this data is ship owners have a lot of things to take care of. So sometimes they just drag and drop in an email the first document that they find. It's not standardized. There is no consistency in the metrics that are being used, and there are a lot of outliners. So our data management solution picks up those outliners, validates the data, cleans it up, and prepares it on behalf of the insurers for the annual report. And actually, next week is the submission of the Poseidon Principle for Marine Insurance 2021 reports. And fingers crossed, we get good grades for those insurers. So wait and see when the reports come out.
It seems to be a theme, not just in the insurance industry, but in most industries, this data ingestion and extraction and transformation. So just another plug for Henry's report coming out in February 2023. We'll be covering all sorts of companies, including S&P, who are helping insurers with that. So finally, what is the future then for carbon accounting and disclosure in the shipping industry?
Yeah, so 3 things to keep in mind. First, we should expect a global carbon tax or a fuel levy to be coming into force for the maritime sector. So the European Committee, the EU, has already decided to include shipping in its EU ETS scheme. So that's the European trading scheme for carbon. And it has been decided at the EU level. However, the IMO has not taken that at the global level, but we expect that they will be playing catching up, and we should see a carbon tax or fuel levy coming in at the global level for the maritime sector. So this is number 1. Number 2, we should expect wider adoption of harmonized carbon intensity metrics and the same targets that are being used by different organizations. So no more 1.5, 2 degrees, different targets. Everyone will be aligning around the 1.5 degree Paris Agreement trajectory. So that's my vision and my hope. And number 3, we should also expect more data transparency and data requirements to come into place, specifically moving into whole life cycle analysis. So not just thinking about the combustion when we talk about emissions, but the whole life cycle of where that fuel came from, what was the intensity of producing that fuel, etc. And no longer speaking about CO2 only, but speaking about CO2 equivalent as well, to bring into account the whole GHG emissions. So I still have 40 seconds. I want to finish with a positive note that I hope the shipping industry can inspire other industries to come up with innovative frameworks such as the Poseidon Principles to really engage into direct communication between the emitters and the insurers, because this is truly the best way of getting to an effective carbon accounting, reporting, and then leading to an effective disclosure as well.
So it looks like a lot of hope. Thank you very much, Christy. Talking about carbon accounting and reporting, we thought it would be interesting to move on to now think about what happens when you know how much carbon you're producing, but you have net zero ambitions. And one way that some companies have been doing it is through offsetting.